This chart tracks a stock price climbing from $4 up to $23 a share, a 475% gain. Surrounding that vertical spike are headlines celebrating the company's entry into a billion-dollar pharmaceutical deal. That ticker belongs to Phoenix Asia Holdings, a Hong Kong substructure contractor specializing in site formation, foundation works, and ground investigation. The market currently values this operation at $500 million. However, the business itself operates with only 21 employees and generated just $7 million in revenue last year. This valuation suggests the market expects flawless execution, but the company's mandatory SEC filings contain several structural warnings that haven't made it into the headlines. When the stock price detaches from the operational reality described in the fine print, the investment moves from a growth play into a high-risk speculation. The first category of risk centers on the breakdown of internal accounting and corporate governance. 42 days after its April 2025 IPO, Phoenix Asia's auditor resigned, citing material weaknesses: no U.S. accounting knowledge, no internal audit department, and missing reporting procedures. This lack of infrastructure led to consecutive late annual filings in July 2025 and July 2026. In the 2026 late filing, management explicitly cited the recent appointment of a new auditor as a reason for the delay, showing that the initial resignation is still impacting their ability to report numbers. Chronic filing delays and the loss of an auditor so soon after going public indicate that a company may lack the basic internal systems required to operate as a transparent public entity. Beyond the accounting issues, the company's stated corporate strategy diverges sharply from its actual experience. This scale reveals a massive pivot: a construction company with $7 million in revenue attempting an all-stock $1 billion acquisition of Asia Pharma. To manage this, they issued a $20 million related party note to Phoenix Prosperity Investment, creating a murky financial link. Meanwhile, the company's core business has very little defensive strength. Guru Focus assigns Phoenix Asia a moat score of 3 out of 10. That score reflects a total lack of proprietary intellectual property, no established brand strength, and no regulatory barriers that would prevent a competitor from taking their market share. Attempting a billion-dollar pivot into the biotech sector without an existing competitive moat or relevant experience creates a high probability of operational failure. The foundational financial metrics show a valuation that has disconnected from the underlying business reality. Current market multiples are absurd. A price-to-earnings ratio of 743, price-to-sales of 64, and price-to-book of 97, derived from just $1.3 million in operating profit. This bar chart contrasts the $23 market price against a fair value of just 35 cents. The company is also facing a significant cash squeeze. Current filings report a negative operating cash flow of $4.26 million. With only $2.99 million in cash on hand and a consistent monthly burn, the company has less than 9 months of runway before its reserves are depleted. This liquidity issue is compounded by a dropping project backlog and a heavy reliance on Hong Kong's public infrastructure budget, which is their only active source of revenue. Shareholders also face incoming dilution. A recent S-8 filing indicates that the company is preparing to issue new shares for internal equity compensation. When you combine that compensation plan with the $1 billion all-stock acquisition, the original shares held by investors will be diluted into much smaller pieces of the total company. Buying into a cash-burning company at a 6,500% premium while massive dilution is on the horizon creates an environment where investors are highly vulnerable to a sudden correction. Phoenix Asia is a micro-cap contractor currently supported by a stock narrative and an unclosed acquisition. Several catalysts could trigger a sharp decline, including failure to integrate the pharmaceutical business, regulatory setbacks, or a downturn in the Hong Kong construction market. The data suggests a simple lesson: never rely solely on a headline, and always verify the risks by reading the SEC filings. Like the video and share it with other investors, and subscribe to help us examine the data that usually stays buried in the fine print. Financial safety depends on personal due diligence. Conduct your own research and always invest with your eyes wide open.